Hey guys, this is the Trading for Dummies series brought to you by Mastermind Trading. Introduction. Previously, we looked at the basics of price action trading and candlestick analysis, explaining how price action basically refers to the movement of price over a given period of time. Now, in this video, we want to look at how price build up over time, forming structures and patterns. Stay with me, guys. Price action and candlestick analysis is particularly important because, unlike other forms of market analysis, price action and technical analysis basically looks at the relationship between price and time. And since time is constantly rolling forward, you get your price chart moving forward in a way that sort of form structures and charts pattern. It is this structure and chart pattern that we want to look at in this video. Market structure refers to the framework of movement of price over time. So basically, when you pull up a price chart, what you see, in most cases, you will see prices moving in a particular direction, forming a particular pattern. Market movement generally can be classified into trends of uptrends and downtrends, and then in range. Regardless of the trend and structure, market structure are usually defined by two swing points, highs and lows. First, there's the bullish market structure or uptrend, which basically shows prices moving in an upward direction over a given period of time. So remember, we define types of market: bullish market and bearish market. Now, in a bullish market, you are most likely to find prices trending upward, forming higher highs and higher lows. As earlier mentioned, market structures are defined by swing points of highs and lows, and in the case of a bull market, you will usually have new highs breaking above the previous high, and then new lows not closing below the previous low. That is basically how an uptrend is defined. You have new highs breaking above the previous highs, and then you have new lows failing to break above the previous low. And then we have the bearish market structure, which is basically a downtrending market structure that usually illustrates price action in a bearish market. Remember, in previous video we explained a bearish market to be a market condition in which we have more aggressive sellers pushing prices down. This market condition is usually characterized by lower highs and lower lows, which is basically prices breaking the previous low every time it goes down, and then failing to break above the previous high every time it bounces back up. And lastly, there's the ranging market structure. A ranging market structure basically is that market conditions where you can't clearly define the highs and the lows in the direction of a trend. So you can't tell for a fact whether we are in a clear uptrend or in a clear downtrend. In most cases, prices move to the side. We have prices moving sideways rather than in an uptrend or in a downtrend. So these are basically the three major market structures that we have based on the direction of a trend: in an uptrend, a downtrend, and in a ranging market. While these are the three major trends we have in the market, traders still look for various market patterns in an uptrend or in a downtrend in an attempt to look for opportunities in the market. Now, here is a list of some of those market patterns. I don't trade market patterns. I pay more attention to market structures than patterns. So guys, remember